For now, let's bring in our market panel. Joining us now, Brook May from Evans May Wealth and Viktor Shvets from Macquarie Capital. Brooke, looking back at the markets overall now, your 2024 price target for the S&P was 5,200 to 5,400 with that would be 5% upside from here within that range, but you upped it 400 points. I mean, from pretty good to outrageously good. Why?
We like earnings. We think that, when we look out and we look at the economy, it's held up. The consumer can be credited with that. And so we're looking at where we are today, and we feel like there is more upside opportunity between now and year end. That said, near term, we wouldn't be surprised if we see some volatility. The market's just shot straight up, and in any given year, the average pullback is about 14%. So a 5 or a 10% pullback from these levels is to be expected, and those are the expectations that we're setting right now with our clients.
Viktor, speaking of expectations, how important is Nvidia and the sort of news that we're getting today in overtime to overall market sentiment and direction?
Incredibly important. You have to remember, U.S. is sort of in the Goldilocks. Number one, we've avoided recession. Number two, we're going to get low interest rates. We can debate how much and exactly when, but we're going to get low interest rates. Number three, QT, or quantitative tightening, is going to end. And on top of that, we have technological evolution. If you think of US SPX, for example, roughly about 60% of the names in that index is directly or indirectly related to new technology, to intangible assets. To give you a perspective, if you do exactly the same exercise for Europe or Japan, you're going to get numbers more like 25 to 35%. So you're in the right technological area, plus a macro backdrop, as was just suggested a second ago, looking good. The only question is extent to which technology will erode aggregate demand and productivity rather than increase. We all agree that over the longer term, it will be substantial improvement in productivity. But longer term is usually at least 5-10 years out. To begin with, you might actually have low aggregate demand. So there is a potential problem down the road. But I said, in the meantime, lower rate, no bankruptcies, no problems. And so why should equity risk premia jump, for example, to derail the market?
Yeah. I want to dig into that a little bit more in just a moment. But first, Brooke, I mean, we had stocks up today. We had yields up today. Is this a sustainable dynamic?
We've seen that there's been a decoupling. For a long time, the bond market was beholden to the Fed and the equity market was beholden to the bond market. So right now, we're finally seeing a decoupling, and we're able to see how they can operate independently. Right now, earnings are strong. As we saw, 73% of companies beat their earnings expectations for this last quarter. And that's right in line with the 10-year historical average. So we're optimistic right now for equities and feel that fixed income right now should be in a trading range, probably between 4.25% and 4.5% for the foreseeable future.
Okay. And Viktor, you were just touching on this, but to dig a little bit deeper, this idea of global secular stagnation, how does that play out? What does that mean in terms of how you invest in a market like this? And I know John asked you how important Nvidia is. What's more important, Nvidia this week or the Fed?
I think both of them are incredibly important because Nvidia is not just Nvidia. I mean, it's like saying Netscape was internet or, Edison and Westinghouse was electricity. As we just discussed, it's a whole ecosystem up and down, hundreds of companies. So it's going to be a very profound, dramatic move. Other countries don't have that, and they're not going to benefit from it, but the U.S. will be the major beneficiary. So it's an incredibly important area for U.S. and something that is keeping your neutral rate higher. In other words, enabling you to withstand higher interest rates than otherwise would be possible. But the Federal Reserve is also critically important, no question about it. The question that Federal Reserve is struggling with, and that's why they are data dependent. You're only data dependent when you don't really know whether you're going up or down. So in other words, Federal Reserve does not see the stars. They don't really know where the R star or the neutral rate is and whether it's coming down or going up. Now, that's a very precarious position. And so the Federal Reserve needs to navigate that. My personal view is that R star or neutral rate has gone up. and it's probably going to come down as we progress over the next 18 months. And as the nominal GDP growth rates of the United States come off from 10% to 5% to 4%, you won't be able to keep your policy rates at 5.5%. So they will cut. It's just getting the timing right.
Yeah.
Interest rates is one thing, but of course we have to think of liquidity as well.
Yes.
Exactly when they will have to end QT.